buy box that highlights what hopefully each and every one of you are doing every day for your buy box. We will talk about the details that allows you to flip from a seller's market to a buyer's market. We'll talk about the JOLTS report. We'll give you a key on what is going on with inventory with Altos Research. We will talk about what Powell has said this morning over in Europe. And of course, folks, we got to talk about Billionaire Barry. Yes, folks, Barry Sternlicht from Starwood is back at it again. What is good old Billionaire Barry talking about today? So let's just jump into it. Let's talk buyer's market. Now, we're going to go over some very specific details about one area, but I want you to take this in and ask about your buy box and your market. So we're going to talk about Manhattan. Yes, probably one of the top 10, maybe the top 5 most expensive cities in the United States. Manhattan has gone full buyer's market. So what does that mean? Well, in order to be a buyer's market, you need to have inventory. You need to have active inventory stacking and ideally above normal. So what does Manhattan have? Manhattan currently has about 8,000 active listings. The 10-year average is roughly speaking 7,000. So their active inventory today is above the long-term average. Now, I know there are some YouTubers out there that like to talk to you about inventory being above last year. That is nearly unimportant because last year in a lot of areas, we were at record low or if not very close to record low. So percentage increases from last year are misleading at best. But hey, when you are above the 10-year running average, you have got my attention. They have 9.8 months of supply. 9.8 months of supply. The long run, often quoted barrier for going to a buyer's market is 5 months. I would actually argue in today's advanced technology, it's more like 4 months. I think we have gotten faster at doing transactions. So again, they are clearly in a buyer's market. Okay, so what does this mean for price? Everybody wants to know about price. They're in a buyer's market, so prices have to be collapsing, right? Hopefully by now you know that that may or may not be the case. So let's take a look at it. So we're going to talk about average and median. Remember, folks, people can confuse you by talking average and medians unless they're very clear. So we have both for you. Average price in Manhattan is down 3%. 3%. It has gone down to just over $2 million. $2 million. All right, what about median? Median, again, because what you're doing is you're taking out the weighting of all the big penthouses and the like. Median is down 2% to just about $1.2 million. So New York has flipped to a buyer's market. We are seeing some softness. But here's the deal, folks. You have heard me quote ad nauseum about the buyers or about the bifurcated market. Below the median, above the median. So what the heck is happening in Manhattan? I love that they gave us this data. The luxury market, which in this article talked about the top 10% of transactions. So again, line up all the transactions, take the top 10% most expensive. The top 10% of the market is down 11%. So if you want to get a deal in Manhattan, if you want to get a double-digit decline, you've got to be, frankly, really, really rich. Because again, that is where the pain is. And not to mention, the inventory is up 22%. So you have inventory up 22%, you have price down 11%, exactly where I told you it would be in the luxury market. So what you're seeing, simply said, is more transactions of very expensive properties, which can pull the market up, just like I talked about last year. It's happening as expected. A couple other things that I thought were very, very interesting about Manhattan If you would have asked, like, this could be a trivia question, and admittedly, I would have got it wrong. In Manhattan, in Q2 of 2024, so very specific, Q2 2024, this is mind-blowing. 62% of all transactions were cash. If you are a cash buyer, do you give a rat's ass about interest rates? Let's say it another way. Only 38% of transactions in Manhattan had a loan. I don't know about you, but that's pretty eye-opening. That is nuts. How about the last thing? Rent. The average rent in Manhattan is $5,100. So, pretty interesting. So at the end of the day, folks, what does this all mean to you? First, it is my hope that you understand your buy box, inventory, actives, pendings, price reductions. What is going on? Because again, I want you to understand that the next 6 months, the market is going to slow down. It's our opportunity to find and or create great deals. Great deals. Talked with Casey from Brick by Brick Wealth the other day, or actually yesterday. I think the video loads today. She just put another house in contract. She got it for less than list price, got 2% credit, and is having inspections likely to get more. This is the time. Some people have to sell, and it is our responsibility to create great deals. It will take time. It will take offers. It will take follow-up. But this is when wealth is created. Another reminder, folks, at 9 o'clock today, so in about an hour and a half, if you are a part of school, we will be going live with Mark, the financial firefighter. We will be talking out-of-state investing, team, markets. Bring your questions. And of course, we will record it because I know not everybody can make a 9 a.m. live stream, so you can watch that later. Also, those for you looking for Anna Kelly's 3-hour class on the economy and you are a part of school, it is loaded as of this morning. It is now available for you. Again, bringing you more and more value. Anna Kelly's 3-hour session is live. Go to Classrooms, find the thumbnail that says special guest. Click on that thumbnail. You will see a growing list of millionaire contributions. And I think Anna's is at the very bottom. Go nuts, go get it. And then finally, the one and only Ty has agreed to a Sunday live stream at 7:30 a.m. to talk all things creative finance. Not only has he given you a 6-hour masterclass, but now he's going to go live and answer your questions on creative financing, lease options, sub-2, wraps, land contracts, whatever the heck you want to talk about, he will be there for you. He's done 30 plus years of creative financing. So again, the school community is rocking and rolling. We just had our first accountability group last night. Thank you very much, Frank. Oh, by the way, Frank is going to be doing weekly accountability calls starting tomorrow, starting Wednesday. So you will look, and if you look at the calendar, you will see weekly accountability calls. Join, ask questions. Let's have some fun. Thank you, Frank, for doing all of that. Something I want to do that I found this article, and I'm going to share with you each of these bullets, and my hope is you feel better. There's a lot of negative news out there. But sometimes if you're on this channel, sometimes we just need to know that even though it's hard out there, we're doing better than most. So here we go. The average consumer has $23,000 in consumer debt. We're talking credit cards. So if you are watching this channel and you have less than $23,000 in consumer debt, you are doing better than most. How about this? If you are watching this channel and you make more than $150K a year, you are in the top 7% of Americans. 37% of Americans are not investing for retirement. 66% of Americans are living paycheck to paycheck. 43% of Americans expect to have consumer debt in the next 5 years. And then finally, 56% of Americans don't have $1,000 for an emergency. So it is my hope that all of you are better than all of those, if not most of those. Because again, I do believe that one rental at a time attracts doers, people that understand it takes work, people that understand there are no handouts. Nobody's here to take care of us except us. So it is my hope that you exceed all of those and are better than most. How about Altos Research? Mike Simonson, again, weekly data, man. He is great, Altos Research, talking about the market has peaked for inventory, right? And listings and all of those things. Says we are entering the second half of the year. The spring selling season is over. And now we will see things like, and this is according to Mike, I'm just quoting his words or at least his writings. New listing data has peaked. Last week we were up 1.8% week on week, 39% year on year. The total inventory peak probably won't happen until October. Why is that? That's because, again, listings, as I have tried to say over the last several months, we will see expireds and withdrawals increase, but that just takes time. Folks, there's a lot of what I call fake listings, wish pricing. Again, I think the active inventory is very distorted. I have no idea what the number is, but it ain't zero. Could it be 10% of all listings are this wish pricing? Probably. 15? Maybe. 20? That might be pushing it. But again, if you take 15% off of active listings today, it is a very, very different picture. How about another LA office tower going for a significant discount? LA office tower at 555 West 5th Street. Wow, that's a lot of fives. It was originally sold in 2021 for $632 million. It had debt at the time of $465 million. It has now been resold or selling at $215 million. What does that mean? That means $167 million of equity is gone. Vamoose, gone, zip, zilch, nada. It also means that the lender is going to take about a $215 million haircut. When I think about these office towers taking these big haircuts, I often wonder who is hurt. Is it an insurance company? Is it a pension company? Right? Who had that debt? Because somebody is taking a $215 million haircut on a safe asset. Folks, these office buildings, an LA office building for, 50 years was considered like the creme de la creme. And now they're getting spanked. The other thing I want to remind you about when this office building retrades is LA County is going to get a lot less taxes. Because again, the tax basis at 632 will not be the tax basis at 215. So lots of stuff going on there. How about CNBC? This article made me smile. If you've been watching this channel maybe for the last 6 or 9 months, you know that one of the things I am, praying, hoping, whatever you want to say it, is that the home builders build smaller homes. I believe the only realistic way out of this is smaller homes. And it won't be fast, it won't be quick, but it is possible. So according to CNBC, the size of a newly constructed home is shrinking. Yay! We should all applaud that. I hope it continues into 2025, 2026, so on and so forth. So where are we at? At the end of 2023, the median new home sold was 2,179 square feet. That is the smallest square feet in the last 13 years. Let me be clear one more time. I hope it gets smaller and smaller. 2 more points. We're going to talk about the Fed, and we're going to close with Billionaire Barry. Don't forget to hit that like button, folks. We got 153 amazing people watching live. Thank you for being here every morning, but we've only got 20 thumbs up. If you've been watching this long, I think I've earned a thumbs up, so do me a favor, hit that thumbs up button. So let's talk about Jerome Powell. Jerome Powell is obviously in Europe. He's speaking at a conference, and he's had a couple of things that will be market moving and probably more coming. But again, this is just this morning. We have time to wait. The strong economy is giving us time. We have made quite a bit of progress on inflation, but we need more confidence. Folks, I don't know. Often parsing Fed speak is frustrating. But according to the betting markets, right, there's a tool called FedWatch. The chances of a cut in September are now 70%, 70. I'm going to stick with my November and them being late in going 50. But yeah, but how, dude, let's just have an honest discussion. Has the market been right all year? This was the tool that told us 6 or 7 cuts, and then 4 cuts, and then 3 cuts. Why does anybody believe this tool? Again, I think the Fed will be late. I think they will take September off. I will agree that a September cut is, you may have enough data for a September cut, but I have said for a long time, probably more than a year, I believe Jerome Powell wants to wait one extra meeting. He is so burned by the inflation is transitory. So there we are, 70% chance. Other thing, it looks like GDP Now. Guys, if you looked at GDP Now, this is a tool, just go to GDP Now. I think it's .com, might be something else, but anyways, look it up, Google it. GDP Now for Q2 was over 4%. It's now 1.7 and clearly on a trend lower. This is pretty cool. All right, lastly, good old Billionaire Barry. Billionaire Barry, the PowerPoint CNBC guy. Well, apparently, Billionaire Barry, aka Starwood, is selling more assets. We're going to talk about why in a minute, but let's just talk about what he sold and who the buyer was. Billionaire Barry sold a portfolio of multifamily properties to Brookfield for $1.6 billion. 1.6 billion. So what did Brookfield buy? They bought 7,300 units across 23 properties, mainly in Florida, Texas, Arizona. So let's call it the Sun Belt. I did some rough math. That's about $220K a door, right? 1.6 billion, 7,300 units, $220K a door. It also said that Brookfield got a $1.1 billion loan. So again, a $1.1 billion loan on a $1.6 billion purchase is, roughly speaking, a 70% LTV. It actually calculated 69%, but I'm going to guess there's some rounding in there. So again, a 70% LTV deal. So what does this mean? Billionaire Barry is selling. Does Billionaire Barry need cash? Come on. You know the answer to that. We've watched Billionaire Barry try to raise cash for a year now. So that answer is self-explanatory. What does it mean that Brookfield's a buyer? You got to ask that question too. Why is Brookfield buying? Well, if you've been paying attention, Blackstone and KKR have come out recently and said, we're buying. Now, again, it's Class A stuff. It's in the right market. You know, those things are important. But yes, it looks like Brookfield is starting to move. And then finally, what does it mean for multifamily deals? Because for a long time, we were having a discrepancy between buyers and sellers. Folks, I simply think this means that the tippity top of the Class A, Class B, Class C buildings is starting to trade. We are having price discovery. We are having Blackstone, Brookfield, KKR. The biggest of the big boys are starting to make moves. Class B and Class C, tons of pain. Tons of unrealized pain is still coming. We are probably in the first inning, maybe second inning of the pain that is yet to come to Class B and Class C. And then finally, folks, we will close with our first of 3 jobs numbers. Yes, remember, we get the JOLTS report, we get ADP, and then on Friday, we will get the big number from Bureau of Labor and Statistics. JOLTS report, what is it? Job openings. Expectations for JOLTS this month was to go below 8 million. Again, remember, we were up around 11 million at the peak of the job market. Again, it was expected to be 7.96. Actual, 8.14. So maybe the job market's not weakening as much. Again, also last month was revised down. Last month was 8.06. Now revised down to 7.92. What does that mean? That means last month broke 8 million. But again, we went up from 7.92 to 8.14. So again, job market is not falling apart yet. Alrighty, folks, I hope you have an amazing day. Remember, school, 9 o'clock. Let's talk out-of-state investing. If you can't make it, no big deal. We will make sure it's live. If you've been waiting for Anna Kelly's talk about the economy, it is now live. You want to talk about creative financing? Congrats, Sunday morning. We've got an accountability group tomorrow in the evening. We've got Henry Washington and Lance Lambert and Coach Carson and many, 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 many more people coming to school. Time to sign up. Time to get in the group with other folks that are doing the work. Take care. Have an amazing day. Later.